Okay, let's unpack this. We're diving into a recent event that, well, really sent ripples through the decentralized finance world. Our focus today is Hyperliquid. Now, this is a platform that popped up in 2023 with a pretty bold promise, right?
Right. They wanted to merge the lightning speed you get from centralized exchanges with the transparency, the core ideas, really, of DeFi.
Exactly. And it's built on its own high-performance Layer 1 blockchain, operates as a DEX, offering, pretty high leverage too, up to 60x.
Mm.
But here's the kicker. It recently had a major outage, a significant one. So our mission for this deep dive is to figure out why this one event, this single incident, tells us so much about the state of DeFi now, and maybe more importantly, the challenges ahead. We're looking at this mainly through recent news and analysis.
And what's really striking here right off the bat is the paradox. Well, Hyperliquid's whole reason for being is speed and performance. That's the foundation. Yet, what failed was something incredibly fundamental. And this is, even more critical when you look at who they're up against. It's a tough crowd.
Stiff competition.
Absolutely. You got giants like Jupiter Perpetual Exchange. I mean, they're sitting on, what, $1.6 billion in total value locked.
Wow.
Then there's Drift Protocol, around $696 million. GMXV2, holding a solid $449 million.
Yeah.
So for Hyperliquid, whose whole pitch is basically we're better, faster, this kind of core failure, it raises some serious questions immediately.
That's a really good point. So, okay, let's get into the nuts and bolts of what actually went wrong. The central problem was a complete failure of their order matching system.
The core engine.
Right. So for users, that just meant, well, they couldn't place orders. Period.
Yeah.
Not a slowdown, a complete stop.
Yeah, full stop.
Now, for a platform that literally markets itself as having the speed of centralized exchanges, how bad is that? I mean, that sounds catastrophic.
It is.
If it's
fundamentally catastrophic.
Yeah, especially when you consider their custom Layer 1 blockchain. Wasn't that specifically designed to prevent these kinds of performance issues that plagued older DXs?
Exactly. That's the irony. When the very thing you're built for, the act of trading, just becomes impossible on your platform.
Yeah.
It doesn't just disrupt things. It completely, pulls the rug out from under their entire value proposition. This incident really shows, quite starkly, that even having this fancy custom blockchain tech isn't like a magic wand for reliability in DeFi.
Right.
It really exposes the fact that achieving that constant uptime, that robustness, it's still a huge challenge, even with cutting-edge stuff.
And a failure like that, it immediately makes you think about trust, doesn't it? What does this do to their reputation, their standing in this really competitive market? Because, I mean, in DeFi, trust isn't just a feature, it's kind of everything.
It absolutely is. It's the bedrock.
Yeah.
Unlike TradFi, where you have regulators and, institutions with long histories providing some baseline trust.
Yeah.
In DeFi, users are putting their faith directly in the code, in the performance. So a wobble like this, it's not just a wobble. It can feel like a chasm.
Yeah.
And traders, they have options, really good options right now. Like you mentioned, Jupiter, with massive TVL, a proven track record of staying up.
They can just move their funds.
Instantly. The DeFi world is incredibly fluid, maybe unforgiving is the right word. Users can, and absolutely will, shift their assets and their trading somewhere else in minutes.
Wow.
So when that sort of psychological contract, that expectation of this will work when I need it, gets broken, especially for a newer player,
Yeah.
winning back that trust, that's a massive uphill climb.
And it's not just about retail traders moving quickly, is it? Hyperliquid has been pretty open about wanting to attract institutional players, right? Offering institutional-grade perpetuals, even with that high leverage.
That's been a stated goal.
But institutions, they have notoriously strict demands. We're talking like 99.9% uptime, minimum, instant execution, things like that.
Non-negotiables, really.
So how does a basic failure like the order matching system just conking out affect those institutional dreams?
Oh, it puts up a huge red flag, a massive roadblock. You can bet that institutional risk management teams, the people deciding where to put serious capital, will point directly at this incident.
As Exhibit A for DeFi maybe not being ready.
Exactly. As tangible proof that, despite the tech, despite the Layer 1 architecture, DeFi might still lack the maturity, the sheer rock-solid reliability of traditional financial plumbing. For institutions, reliability isn't just nice. It's the absolute foundation for deploying capital. An outage like this, well, it seriously undermines any claim of being truly institutional grade.
Okay, and then there's the timing. The timing of this outage seems particularly bad, given what was happening in the broader market.
Right, context is key here.
Yeah, so picture this. Bitcoin was testing some pretty critical resistance levels, wasn't it? Up around $120,000 to $123,000.
Lots of tension there.
And traders were trying to position themselves, maybe for an altcoin season kicking off. We even had some mixed signals floating around, like Bitcoin consolidating a bit lower, around $118,000, $119,000, and BNB actually dipping, what, almost 3%?
Yeah, a volatile, uncertain period.
So during times like that, traders absolutely need instant access. They need to manage their positions, react to news, jump on quick price moves. What's the real cost when they just can't? When the platform's down?
The cost is huge. It's multi-layered. First, there's the immediate financial hit. If you can't manage your position during high volatility, you might be forced to just accept significant losses.
Ouch.
Or the alternative is scrambling, trying to move your funds and positions to a competitor mid-crisis, which is stressful and risky in itself.
Right.
But beyond the immediate user pain, there's this massive opportunity cost for Hyperliquid itself. Users who are forced to migrate during a crisis, well, they often find a new platform that works.
And they might just stay there.
Exactly. They might not come back. So you risk a permanent loss of users, a permanent reduction in your active trader base, and your overall trading volume. That kind of blow takes a very long time to recover from, if ever.
This outage, it feels like it ripples outwards beyond just Hyperliquid. It touches on the whole perception of the DeFi industry, doesn't it? I mean, we generally think of DEDX as maybe more secure than centralized exchanges in some ways, custody-wise, but they're clearly not immune to operational problems.
Not at all.
So this incident, it just kind of adds fuel to this growing conversation, maybe growing concern about the reliability of DeFi infrastructure overall, especially now when the industry really wants to project maturity.
That's a really crucial point. You're absolutely right. An event like this, especially at a high-profile project promising high performance, it inevitably attracts more scrutiny.
From regulators, maybe?
Potentially from regulators down the line, yes.
Yeah.
But certainly, more immediately, it means more stringent due diligence from users, both retail and institutional. People will look harder. And it's important to be clear, like you said, this was an infrastructure failure, not a hack, not a security breach. They're different problems.
But the impact on trust.
The impact on trust can be remarkably similar. In the crypto space, rebuilding that kind of trust deficit, whether it's from a security issue or an operational failure like this, it can take months, sometimes years. It slows down that whole narrative of DeFi being a truly reliable, viable alternative.
So wrapping this up then, what does this all mean for you listening right now? I think the Hyperliquid outage serves as a pretty stark reminder, really. It shows that even with advanced tech, even with custom-built blockchains, that fundamental challenge of reliability, it's still a major hurdle for DeFi to clear. It really throws a spotlight on those immediate issues of trust, the intense competition, and also those longer-term questions about attracting institutional money and, dealing with potential regulatory oversight.
And building on that, perhaps this whole situation raises a more fundamental question for you to think about. What does this incident really suggest about the trade-offs we might have to accept? The trade-offs between pushing innovation forward, sticking to the core ideals of decentralization, and at the same time chasing that institutional-grade, rock-solid reliability that the traditional world demands. Where does the balance lie in this rapidly evolving DeFi space?